So now when they come into the market, into the new issue market, they can come using different methods. So that is what we are going to discuss in our today's class. What are these methods that are used by companies or corporations when they approach the market for raising their capital or for meeting their financial requirement? That is a discussion for our today's class. So, primarily, when we look from the context of India, the methods used or the kinds of issues that are made by Indian companies can be classified into four categories. Okay, it can be classified into four categories. One is called as the public issue, second one the right issue, third one the bonus issue, and the last one private placement. We had already had some kind of discussions regarding the private placement, but we will go detail into that in our today's class. Going with the first one, the first, as we say, the first kind of issue that's very common is public issue. So as the name indicates, the company making its offer to the public, which will be brought under the category of public issue, okay, to the general public, right? That's the context of public issue. So that is why it has been put when an issue or offer of share, because it's an offer. Why? It's not mandatory for the public to subscribe to that. If they want, if they find the company's offer to be attractive, they can go with purchasing the shares of the company. That's why it's the issue. It's been issued by the company in the way of making an offer to the public, and this can be share or convertible securities. That is, normally it can have an option to convert to another form. Suppose if it's coming up with shares, it has an option to convert into debt instrument in future or vice versa. That's why we say that convertible securities. It's made to the new investors for becoming part of companies ownership. That's for becoming company shareholders. And the entity, the company which is making the offer, is called as the issuer. And this will be brought under the category of public issue because it is offered to the entire public. Anybody who would like to buy, who is having money, who is interested to take up this offer is free to do that. That's why it's said as public issue. Okay. So public issue is offer of shares or convertible securities made to the public. Okay. Inviting their participation in the company's ownership by becoming shareholders. Now, this public issue, we can classify that broadly into two. One is initial public offer, which is very common. We call that as IPO or FPO. Okay, so public issue can come under two categories. One is initial public offer. As the name indicates, it will be the first kind of or new issue made by a company in this regard to the public. And further public offer or follow-up is once a company had already taken up the market, they have already gone with the issue of their shares in the market. The next time when they come, that will be brought under the category of further public offer or FPO. So that's why public issue can happen in two ways. One is initial public offer, another one is further public offer, or otherwise called as IPO and FPO. Okay, so let's take the first one, initial public offering or IPO. It's the first, as the name indicates, it's the first kind of offering made by the company, either in the form of equity shares or convertible shares. And once the company brings its share to the market, then the listing of that share in the stock exchange, that is moving that to the secondary market, also is expected in the coming future. Why? Because that listing only will enable the investors to trade in the market, or it only will provide liquidity to the investors. They can sell that, or maybe they can buy that at a later stage if there is an active secondary market. So that's why initially it is brought to the new issue market. It's offered to the public with, if you take up the example of any company, when they bring the offer itself, they will also specify a date when that will be listed in the stock exchange. So So that's actually a mandatory process in the current perspective, because that only will make the offer attractive to the investors, because nobody would be wanting to stay as the owners to the company for a long time other than the promoters. They might be wanting to shift from this company to another company when a better offer comes, right? So that is possible only when there is an active secondary market, right? So in this context, we also would be looking into the IPO, that is initial public offer, which is brought in for the first time, later followed by a listing in the stock exchange. And when the company is trying to meet the initial or bring the public offer for the first time, they have to satisfy the conditions which is being laid down by SEBI regarding the public offering to go with an IPO. And broadly, if we look, as we said, this is an opportunity for the company, okay, to get or to meet the financial requirements by collecting money from the public, by inviting investments from the public. It's a kind of investments, because if they believe in the company, naturally, if they believe in the company's products or services, and if they find that the company is a promising one, it can give them good returns to the investment, people would be coming for that. So that is why it is said that it is an opportunity for the issuer. Issuer in this case would be company, to obtain capital by offering shares. Shares are unit of ownership through primary market, through the new issue market. So that's initial public offering. Of course, there are conditions to be satisfied by Security Exchange Board of India before they go with an IPO. And at the same time, they also has to comply with the Companies Act 2013 regarding the regulations which are connected with initial public offering. So these are the mandatory conditions which they have to satisfy before going for an IPO. Now going with the next one, it is FPO, follow on offer or further public offer. FPO, further public offer. So that name itself say that a company coming again with an offer to the market will be brought under the category of FPO. They have already gone for the first time through the IPO. Now they again are planning, or they are trying to make an offer to the public. Maybe they are going with a new development activity, or maybe they are thinking about expansion of their business, and in that context they need funds, so they are coming into the market with a further public offer. Yes, we are very attractive. They would be saying that offer will contain all these things, like we utilize your initial money which were invested with us, we could gain a return of so and so, and now we are planning for an expansion in the coming future. In this regard, we would like to invite you to, or we would like to invite your partnership or your contribution to that capital through further public offer. So that's what the content or the context of further public offer or FPO. So that's why I put when an already listed company, because when they went with the first offer, they got the offer, people subscribed to that, later they got themselves listed in the stock exchange. Now we know what is listing. Listing is nothing but entering the company's name in the official list of the stock exchange. So the company's shares will be traded in the stock exchange. Say, for example, Bombay Stock Exchange or National Stock Exchange, or they can get themselves listed in BSE as well as NSE, or maybe they prefer to be there in BSE only. It's their choice, but listing will be mandatory condition for these companies to allow liquidity for their shares. So that's why when already listed company makes a fresh issue of shares or convertible securities to the public through an offer, or it can be by the company can think of, later we are going with that, the company can think of other methods also, but then when they are offering it to the public, that will be brought under the category of further public offer or FPO. So when already issued and listed, company is coming up with a fresh offer that will be brought under the category of FPO. Okay. Now the next one. So we said the companies can think of bringing their shares or can think of making offer primarily through 4 channels. That's what we said at the beginning. One is public issue. And in public issue, there are 2 categories, that is initial public offer and FPO, follow-up offer. Okay. And then we said that there can be right issue or bonus issue or private placement. So we are going with the second one, which is right issue. When an issue of shares or convertible securities is made by the issuer to the existing shareholders as on a particular date fixed by the issuer in a fixed ratio, that will be brought as right issue. So here you can remember the keyword here, which is right. It's my right. Since I'm already the owner of this company, the company is giving me privilege for that. So that's why this right issue comes from the perspective of offering that to the existing shareholders. So that's why it is named as right issue. Already say they would mark up a date, maybe all those shareholders who are there in the books of the company till maybe August 31st. All of them will be made with the right issue. And it's your privilege. So if you want, you can take up the offer. If you do not want, you can just leave it like that. So it's an offer made to the existing shareholders, as on the company's book on a particular day. Maybe there will be a definite proportion of such issue of because the company might be going with a composite issue where part of the shares are given as right and the other part is going with public issue. In that case, there will be a definite portion that is offered to the existing shareholders and the rest to the public. So right issue is in a precise way, it is the offer made to the existing shareholders by the company in recognition of their partnership in the management of the company, because they were they had confidence in the company, they had invested their money with the company, and now the company is growing, the company is thinking of expansion, the company is making profit, and they would be liking to share that the right, the ownership right again. And there can be another back-end reason for right issue, that the company does not want to invite more shareholders to dilute the ownership. So if I'm giving to the existing shareholders, the number of shareholders would be limited, but the number of shares with them might be increasing. So that can also be one reason why the company is going for right issue. They want to limit the number of shareholders, but the number of shareholding with them can increase through right issue. So that can be one reason. Or it may be a privilege that is given to the existing shareholders for believing in the performance of the company, right? So that is about right issue. Now the second one, okay, the next one which we would be discussing is, okay, this is composite issue. Means, as I said, when the company is planning for an issue, part of it will be going as public issue, and the next part they will be thinking about going with the right issue. So when there is a combination of right issue and public issue, we call that as composite issue. If it's alone, if the company is going with right issue alone, then in that case, what we would be saying is that is just one aspect where the existing shareholders are offered with the company shares. But if it is a composite offer, here the existing shareholders are given with designated shares. At the same time, a portion is also placed before the public for as an offer for inviting their contribution, for inviting them to become the shareholders of this company. So that is what we mean by composite issue. Now the next one for our discussion today is bonus issue. See, when I invest my shares with a company, basically what I expect is I expect a return, right? I expect a return, and this return earned by the company can be paid in cash or in kind. One such payment in kind is bonus issue. That is, I can the company can give me money in the form of dividend, okay, in the form of dividend by giving me a DD. Say suppose normally, when you go with investments, and if the company has gone with declaration of dividend, what happens here is a DD or demand draft, or maybe a check, or maybe the dividend as such, the amount is credited to my account. That's payment in cash. But a company, instead of going with issue of dividend in cash, they can think of issuing that in kind. Say, when does a company think like this? Maybe the company is having further development or growth opportunities, and the company would like to capitalize on that. They don't want to distribute uh, as such the earnings. They want to retain it with them so that it can be used for the further development process. Then the company would be thinking about going with bonus issue. Okay, so bonus issue is nothing but issue of shares to the existing shareholders without any consideration based on the number of shares already held by them. Right? So they are already owners of the company on a recorded date, and then the company is sharing the profit of that ownership by issue of shares. That will be brought under the category of bonus issue. So that when the company is issuing shares, that is issue of profit in the form of shares, that is called as bonus issue. That's why the company will not take any consideration. Why? It's actually the profit that belongs to the shareholders that is distributed in the form of shares. So bonus issue is that. And shares are issued out of companies. We will learn when we are learning about company accounts, we will know that issue of shares, bonus shares, is made out of the reserves. Either it can be from the share premium account, or maybe a free reserve that is created by the company for the issue of its bonus, for the issue of bonus shares. So it depends. Generally, that is out of the reserve created with this designated purpose. So that's what happens when a company is having a planned growth strategy. Okay, so bonus issue is part of profit distributed in the form of shares. That's what we mean by bonus issue. That's why this issue is an offer made to the existing shareholders, and this amount of shares or the number of shares depends upon their ownership, the volume of their ownership with the company. So that's bonus issue. So we said about public issue, we discussed about right issue, we discussed about bonus issue. Now what is left with us is private placement. When we talk about private placement, we had a previous discussion about private placement when a company makes its offer to a specific group of people, to a selected group of people. Then that we call as private placement. It is not open to everyone to go with subscription to the company shares. It is offered. The offer is open to a selected group of persons not exceeding 49. That's something which is laid down in Companies Act 2013, where it says that the selected group of persons should not exceed 49 in number. Okay, so that's what they go with the private placement. And broadly, private placement can be categorized into three, which is preferential allotment, then QIP, qualified institutional placement, and institutional placement program. Okay, so preferential allotment, as the definition says, the offer is made to a selected group of persons. And when we talk about qualified institutional placement, it is those institutions which are registered under the purview of SEBI will be qualifying with getting this offer for private placement. So it happens like private placement. The only difference what you can find is they are broadly institutions that are engaged in trading or investing or marketing or advisory share services in share market. So qualified institute, it can be with banks, it can be with mutual funds, it can be with life insurance companies. All these can qualify for QIP. Okay, and what we have to understand is most of the large kind of private placement will be placed before QIP, not before the individual investor group. This will be because the chance of that the offer being accepted is more with qualified institutional placements. Now, institutional placement program is comparatively new in origin in the Indian context, but the broader difference between private placement and the broader placement between QIP and IPP, that is institutional placement program, is, see, earlier no, the SEBI had gone with like the previous notification around 2012. SEBI came up with a proposal that the public company, they have to go with raising their subscription, their public subscription. So when they went with this guideline, they also came up with the offer of institutional placement program, because QIP offer cannot exceed 25% of the total volume of the capital. So in that case, the public companies, if they want to increase, the government companies, if they want to increase their shares, automatically they have to find some other route. So this was one of the route that was offered by government to increase their public participation in the share capital, that is IPP. So it is more or less like a public issue. It's not a private placement, purely a private placement which are offered to a specific group, but it will include a larger denomination who can actually, it is part of public issue. So that's a basic difference between QIP and IPP. QIP generally comes with a pure private placement, where it is offered to a particular group of institutional investors. And institutional placement program is more or less like a public issue. A larger group of people are being offered with that, but still it's not open to everybody. Anybody who wants cannot take up this offer. There is a limitation with respect to this offer, but it is more it has more coverage than what we tell from the perspective of QIP. So this came up with with an offer for the public companies to enhance the public participation in the capital, that like government public private partnership as a mode to increase the private partnership. This IPP program came up as an offer from SEBI to mitigate that plan of increasing the share of private participation with respect to government companies. So that is where this IPP program stands as a tool for increasing the capital, increasing the private partnership in the capital structure of companies. Okay, of public companies. So private placement, in short, what we can see is it is the offer to be part of shareholder, to be part of the shareholding of a company is limited to a particular group. It's not open to all. It's not open to the public. It is limited to a particular group. And this particular group can be individual investors. It can be institutional investors, right? And depending on that, it can be categorized into three. One is preferential allotment, which is generally made to a group of individuals, group of persons. Another one, QIP, which is placed before institutional investors. And the third one is institutional placement program. So these are the different categories of private placement. Okay. So we said about the methods or the kinds of issue can be classified into four. One is public issue, two is right issue, three is bonus issue, and four is private placement. So these are the major four kinds of issues that will be made by a company in the new issue market. Again, public issue, we categorize that into IPO and FPO, follow-up as well as the initial one, right? Initial public offering. Now going with the next part of our discussion, which is the types of offer documents. So I can quickly say this. This is very simple. Types of offer documents, as you can see, primarily the offer document is categorized into two. One is prospectus, that is used by a company when it goes for a public issue. Letter of offer, that is used when there is case of right issue. Right issue, we know that this is made to the existing shareholders. So it can be broadly categorized into prospectus and letter of offer. Now, initially, when the company is thinking of a public issue, you can just visit the SEBI website and you can see that there are a lot of draft documents being submitted by company, which are open to public, and anybody who would like to know about the company, anybody who would like to uh, anybody who is interested to know more about this offer can just read through that. So it's a draft document prepared as per the guidelines of the SEBI and submitted with the SEBI for getting their approval to making for making this offer to the public. So that is the first kind of document that needs to be submitted with the SEBI with no, if a company is planning to make a public issue. Then the second one, that is, it's not mandatory. Suppose we are yet to learn about book building process. It's actually a band, price band is given, and the investors are asked to suggest one price. And the highest bidding price, based on that, the allotment will be made. We will learn about this in the next few classes. So when we are talking about book building process, the offer document, the first document would be red herring prospectus, and the prospectus will be filed with the SEBI only after finalizing the offer. It's not the prospectus, it's a red herring prospectus that will be used in case of which contains all the details, all the offer, the price band, the reason for going for this public issue, all these will be there. But in case of book building process, we will go with the red herring prospectus instead of a draft prospectus. And then as you can understand, prospectus is generally an offer document which talks about the details regarding this public issue and why, what is it company planning to do with the money collected through this public issue. Then only investors will be confident to invest. They should understand why the company is going to collect this money. Is it because that they are making loss, or is it because that they have future opportunities to invest and then gain more return? So all these things will be given in their prospectus. Now, as I said, no, letter of offer is something which is given during the time of right issue. Then going with abridged prospectus, that is, suppose when the company is made, you can see that in the newspapers at times, in the financial newspapers, when the company is going with an application, inviting an application from the public for subscription to the shares, they also will be giving a short glimpse of the prospectus, an abridged prospectus, a short document which talks about the major details of why the company is going for this pub. It's not as elaborate as a draft prospectus or a prospectus that is filed by the company with SEBI, which is published in SEBI's website, but a summary of all the details will be given, will be published along with the abridged along with the application form. When I'm collecting the application from my say from my intermediary, maybe from my broker like Geojit or Hedge, I also with get a bridge prospectus along with that application, which states why the company is going for and what is the volume of capital that will be increased because of this offer and how it is placed, who are ROs, registrars to companies, and merchant bankers and bankers to issue. All these details will be there in that abridged prospectus. So that is a short or summary of the existing prospectus that is given to the prospective investors along with the application. So that is what we call as abridged prospectus. The same purpose, when it is given at the time of right issue, we call that as abridged letter of offer. We know that in case of right issue, it's not prospectus, it is letter of offer. So a summary of letter offer, when it is given at the time of offer, it is called as abridged letter of offer. And then the next document which talks about is shelf prospectus. Now, what you have to understand is shelf prospectus is something that will be used by a company when a company is planning for more than one issue. Say one time, if you're going with an issue, you will go with a prospectus stating all the details. Then you go with your offer, you will close your issue. But if the company is planning to offer that in a series, Maybe the development process of the company is in the pipeline, and if they want to go with this issue over a period of 1 year as a series, in that case they will be going with a shelf prospectus that will be filed with the SEBI, and it is open to everyone. Anyone who would like to read through it, who would like to have a glimpse of it, can visit the SEBI website and read through it. Right. So this is when a company is going with a series of issue, then the kind of prospectus that will be issued by the company, filed with the SEBI, will be called as shelf prospectus. And the last one is placement document, which we are going to discuss in our class. And the placement document is, as the name indicates, it is associated with private placements. That is, it is the prospectus that will be filed, that will be given along with the application along with the offer document, that is application in case of private placement. So that is why I have put in brackets QIP. Institutional placement. At times of qualified institutional placement, the prospectus will be called as placement document. It contains more or less similar details, which talks about how the company is going to utilize this fund, what are the plans in the company's plans associated with plans for the company associated with this particular offer. All these details will be given in that. So in short, to summarize, in our class today, we discussed about the kinds of issues in a new issue market, where we said there are broadly 4 types of issues, which includes public issue, right issue, bonus issue, and private placement. Public issue, the issue is open to the general public, taking care of the different categories, whereas in case of right issue, it is open to only the existing shareholders in the books of the company as on a specified date decided by the company. Then the third one we talked was bonus issue. As I said, share of profit being distributed to the existing shareholders can be in cash or in kind. When the company has decided to give the share of profit to the existing shareholders in the form of shares, that's what we call as bonus shares. And that's why the company does not receive any amount for such issue, because it is a consideration for being the owners of this particular company, and owners naturally should get the reward, and that reward is in the form of profit. It can be issued in the form of shares, and when it is issued in the form of shares, we call that as bonus shares. And the last one is private placement, and we said when the shares are offered to a particular group of investors, not open to the general public as a whole, it will be brought under the category of private placement. There also it can be either institutional investors or individual investors, right? Depending on the requirement of the company. Then we talked about offer documents. Broadly, it can be categorized into prospectus and letter of offer. Prospectus are applicable in the general kind of public offers, in the general kind of issue of shares, other than right issue. In case of right issue, what is used is letter of offer. Of course, then we talked about different types of prospectus, which involves draft prospectus, red herring prospectus filed at the during the time of building process, or abridged prospectus, short summary prospects, which are given at the time of offer made to the public. It is also being given along with the application form. Then shelf prospectus, when the company is planning for a series, a set of offers during a limited period, maybe 1 year. And of course, we talked about placement document, which are mainly related with private placement.